Welcome back. Today we're taking a deep dive into something pretty fascinating, the Rule of 72.
The Rule of 72.
It's a powerful financial concept that can help you grasp the magic of compound interest.
Compound interest.
Exactly. Now, before we get lost in the numbers,
Right.
can you just quickly explain what this rule is all about for those who might not be familiar?
Sure. The Rule of 72 is basically a simple way to figure out how long it'll take for your money to double given a specific interest rate.
Okay, so like a quick and dirty estimation.
Exactly. It's a really handy tool.
Got it.
And it works like this. You take the number 72 and divide it by the interest rate.
Okay, so if I have an investment earning, let's say 6% interest,
6%.
I divide 72 by 6,
You got
which gives me 12.
12 years. That's approximately how long it would take for your investment to double.
So simple. See, I told you didn't need to be a math whiz for this.
Nope. Anyone can use it.
Okay, I'm starting to see how this could be helpful. But, for a lot of people, compound interest can feel kind of abstract.
It can.
Like, how do we actually see that snowball effect in action?
Well, think of it like this. You're not just earning interest on your original investment. You're also earning interest on the interest you've already accumulated.
So it's like interest on interest.
Yes, it's like a chain reaction. Your money starts making more money, and then that money makes even more money, and so on.
Okay, now I'm starting to get the picture.
It's pretty amazing when you see it in action.
And I love how our source material provides some really clear examples to illustrate this point. For instance, let's say you have $1,000 sitting in a high-yield savings account, currently earning a modest 2% interest.
Okay.
Using the rule of 72,
Yeah.
we could quickly estimate that it would take about 36 years for your savings to double to $2,000.
36 years. That's quite a while.
Yeah, it really highlights the impact of those lower interest rates, doesn't it?
It does, especially when you compare it to something like
Like investing in the stock market.
Exactly. Let's say you take that same $1,000
Same.
and invest it in a diversified portfolio of stocks, aiming for an average annual return of 7%.
Okay, so a bit more risk, but potentially higher returns.
Yeah, exactly.
Well, the rule of 72 suggests that it would only take roughly 10.3 years for your investment to double in that case.
Wow. That's less than a third of the time compared to the savings account.
That's a pretty striking difference. And it really shows how those seemingly small percentage changes in interest rates can have a massive impact over time, especially when compounded right.
Absolutely. That's the beauty of compound interest.
So it seems like the rule of 72 can be used for more than just basic savings and investing scenarios.
Oh, absolutely. It's a really versatile tool.
Really? Tell me more.
You can apply it to understand the growth of anything that compounds, not just your money.
Like what? I'm curious.
Well, think about inflation. The rule of 72 can help you visualize how quickly rising prices can erode the value of your money.
No, interesting. So it's not just about our investments growing. It's also about understanding how our purchasing power can shrink over time.
Exactly. And you can even use it to understand things like population growth and how that might impact resource allocation or even economic development.
Wow. So the rule of 72 isn't just a financial tool. It's a lens for understanding growth and change in a lot of different areas.
I like that. A lens for understanding.
Right. It's about making informed decisions.
Exactly. Whether it's about your personal finances or even broader societal trends.
I think our listeners are going to find this really insightful.
I hope so. It's a game changer.
Okay. We've got a good grasp of the basics now, but I'm also curious about the nuances of applying this rule in different situations.
Okay. Nuances.
I mean, it seems like there's a lot more to unpack here, particularly when it comes to things like retirement planning.
Yeah.
Or even setting those short-term savings goals.
Right, right. And luckily, our source material actually goes into quite a bit of detail on those specific applications.
Perfect. Let's shift gears then and explore those nuances a bit more deeply.
Sounds good.
Starting with investment planning. Imagine you're faced with a ton of different investment options out there.
Oh, yeah.
Like, how can the rule of 72 help someone navigate that,
That jungle.
that jungle of choices? It could be so overwhelming.
It can, but the rule of 72 can actually be really helpful in that situation.
Okay, I'm intrigued. How so?
Well, let's say you're trying to choose between a low-risk bond yielding 3%
Okay.
and a volatile stock averaging a 10% return.
That's a tough one.
It is,
Yeah.
because you have different levels of risk involved.
Right. You have to balance that potential for higher returns
Right.
with the possibility of losing money.
Exactly. And that's where the rule of 72 can give you some clarity.
Okay. How does it help with that?
You can quickly calculate that your money would take roughly 24 years to double with that 3% bond.
Okay.
while the stock, with its 10% average return, would take around 7.2 years.
Wow, that's a huge difference. I mean, we're talking about less than a decade versus over 2 decades.
Yeah, big difference.
So the rule helps us see that trade-off between risk and reward a little more clearly.
Exactly. It gives you a snapshot of how those different options might perform over time.
Got it. So it's not just about picking the investment with the highest interest rate. It's about finding that balance that fits your own risk tolerance and goals.
Absolutely. It's about aligning your investments with your own personal circumstances.
This is making a lot of sense. But I do have to wonder, the rule of 72 seems pretty straightforward, but
Yeah.
isn't it a bit overly simplistic in today's market? Especially with all the volatility and things like inflation eating into our returns.
You bring up a great point. The real world is definitely a bit more complex than a simple formula can capture.
Right. There are so many factors at play.
Definitely. And that's why it's crucial to think critically when applying the rule of 72.
I'm all ears. Let's explore these limitations a bit further.
Okay, let's do it. The rule of 72 doesn't take into account those real-world factors you mentioned.
Yeah.
Like inflation.
Yeah, inflation, taxes, fees.
All of that.
Yeah, all those things can really impact your actual returns, can't they?
They definitely can.
So how should we be thinking about those limitations when we're using the rule of 72?
Well, it's like having a map. It shows you the general direction, but it doesn't account for every little detour or road closure you might encounter along the way.
That's a good way to put it. So it's important to remember that it's just an estimation tool.
It is. It's a starting point.
Right.
But you got to use your own critical thinking to fill in those gaps.
Got it. So what should our listeners watch out for? What are some specific things to keep in mind?
Okay, well, first off, be mindful of fees. Investment fees can really eat into your returns over time.
Like what kind of fees?
Well, there are all sorts of fees associated with investments. You've got annual expense ratios on mutual funds, brokerage commissions, even account maintenance fees sometimes.
Oh, wow. It sounds like death by 1,000 cuts.
It can be. And all of those little fees can add up and extend the time it takes to double your money.
Right, because even a small percentage fee can compound over time, just like our investments, but in the wrong direction.
Exactly. And then there are taxes. When you sell an investment for a profit, you usually got to pay taxes on those gains.
Yeah, that's easy to forget about. It's like a hidden cost.
It is. And it can definitely reduce your overall returns.
Okay, so fees and taxes. Those are two big ones to watch out for. Are there any specific examples from our source material that illustrate how these factors can,
Skew things.
skew things? Yeah.
Oh, yeah. There are some good ones. Let's say you're looking at two investments, both with a projected return of 6%. One is a low-cost index fund with an expense ratio of 0.1%,
Okay.
and the other is an actively managed mutual fund with an expense ratio of 1%.
Okay, so the returns look the same on paper.
Yeah, on paper they look identical, but those fees can make a big difference.
Right, because if we just plug that 6% return into the rule of 72, it would say both investments would double in about 12 years.
Yeah, around 12 years.
But in reality,
That's
that's not necessarily the case.
Nope. Once you factor in those expense ratios, the picture changes. That low-cost index fund would likely double a bit sooner.
Because of those lower fees.
Exactly. Maybe around 11 and a half years or so.
Okay.
While that actively managed fund
With its higher fees.
might take closer to 13 years.
Oh, wow. That's a difference of over a year just from those fees.
Yep. More than a year. And that's why it's so important to look beyond just the headline return and really dig into those details.
Makes sense. So the rule of 72 can be a good starting point, but we need to be aware of those finer points that can really impact the actual outcome.
Absolutely.
Okay, so fees, taxes, those are important. But what about market volatility?
Ah, yes. Market volatility. That's the big wild card, isn't it?
It is. I mean, the market doesn't just go up in a straight line, does it?
If only it did. But unfortunately, it doesn't work that way.
Right. There are ups and downs, sometimes big swings.
All the time.
And that can make it tough to actually hit that consistent rate of return that the rule of 72 assumes, right?
Exactly. And that's one of the limitations of the rule. It assumes a steady rate of return.
Okay, so how can we account for that volatility when we're using this rule?
Well, it's not about accounting for every single up and down.
Right.
It's more about understanding that the rule gives you an estimate
Did estimate.
based on an average return. But in the real world,
Yeah.
Your actual returns are going to vary from year to year.
They're going to bounce around.
They're going to be all over the place. Some years will be great, some years will be not so great.
So we got to be prepared for that roller coaster ride.
Exactly. And that's why it's crucial to view the Rule of 72 as a long-term planning tool rather than a short-term prediction model.
Right. It's not a crystal ball.
It's not.
It's more about understanding the general power of compound interest over those longer time frames.
Exactly. It helps you see the big picture, but it doesn't guarantee specific results in any given year.
Got it. So we've covered the formula, the benefits, the limitations, all of that good stuff. But I know our source material also dives into some really specific applications of this rule,
It does.
particularly when it comes to retirement planning and setting short-term savings goals. I think those are areas where a lot of our listeners are probably really curious.
Yeah, I think so too. These applications are where the Rule of 72 really shines.
Okay, so let's jump into those specific examples then. Starting with retirement planning, which can feel like a pretty daunting task for a lot of people.
Yeah, it can.
But how can the Rule of 72 make that process a little less intimidating?
It can help you visualize the power of starting early.
Okay, let's say you're 25 years old,
All right, 25.
just starting out your career, and you're thinking, okay, retirement, I know I need to start saving, but it feels so far off.
Right.
How does this rule help in that situation?
Well, imagine you're aiming for an average return of 6% on your retirement investments.
6%.
The Rule of 72 tells you that your savings would double roughly every 12 years.
Every 12 years.
So if you invest, let's say, $10,000 at age 25,
Right.
it would grow to $20,000 by the time you're 37,
Wow.
$40,000 by 49,
Keep going, I like this.
and so on. It really shows you that snowball effect in action.
It's like a financial time machine. And shows you that even those early contributions can grow significantly over time.
They can. It's amazing what compound interest can do over those long time horizons.
Okay, so the earlier you start, the better.
Absolutely.
But what about those who maybe didn't start saving in their 20s? Is there still hope for them to catch up?
There's always hope.
Okay, good. Because I'm sure a lot of people listening are in that boat.
Yeah, and for them, it might mean saving a bit more aggressively.
Right.
Or maybe choosing investments with potentially higher returns.
Okay, so they might need to adjust their strategy a bit.
They might, but it's definitely not too late to start saving for retirement.
That's good to hear.
And that's a key takeaway from the Rule of 72. Those early years are powerful. But even if you get a late start,
Yeah.
you can still harness the power of compound interest to build a solid nest egg.
Got it. So time is our friend.
Time is your best friend when it comes to investing.
Okay, so we've talked about long-term goals like retirement.
Yeah.
But what about those who are saving for something more short-term,
Short term.
like a down payment on a house or a dream vacation?
Oh, yeah. The Rule of 72 can be helpful for those goals, too.
Really? Okay, how so?
Let's say you're saving up $10,000 for a down payment,
Okay, $10,000.
and you found a high-yield savings account offering 2% interest.
All right, 2% interest, not bad these days.
Not bad at all. Now, if we use the Rule of 72,
Yeah.
we see that it would take about 36 years for your savings to double to $20,000.
36 years. Wow, that's a long time for a short-term goal.
It is. But here's the key. You don't need that full $20,000.
Right.
You only need to reach your $10,000 target.
Okay, so we could use the rule to kind of break it down.
Sure.
See how much we actually need to save each month to hit that goal within our desired time frame.
You got it. The Rule of 72 helps you work backward from that doubling time to figure out those smaller, more manageable savings targets.
Oh, that's clever. So even if that full doubling time feels really long,
Yeah.
we can use it to chunk it down,
Chunk it down.
make it more achievable.
Exactly.
I love that.
So whether it's a long-term goal or a short-term goal,
Yeah.
the Rule of 72 can help you make those informed decisions about your savings plan.
It's like a personalized financial roadmap. I think a lot of our listeners are really going to appreciate that.
Me too.
But, you know, beyond the actual numbers, I'm also struck by how the Rule of 72 can promote financial literacy.
Absolutely. It's not just about crunching numbers. It's about understanding those core concepts.
What do you mean by that? Like, what aspects of financial literacy does it really highlight?
Well, by using this simple formula, people can really grasp how compound interest works
Yeah.
and how it can impact their financial future.
So it's about empowering people to take control of their own finances,
Yeah.
to make informed decisions,
Yeah.
and work toward their goals with more confidence, right?
Exactly. It demystifies these financial concepts
Right.
and makes them accessible to everyone, regardless of their background or expertise.
I love that.
Yeah.
It's like giving people the tools they need to navigate the world of personal finance, which can feel pretty intimidating sometimes.
It can be a scary world out there, but with a tool like the Rule of 72, it becomes a lot less scary.
Okay, so we've explored a lot here today.
We have.
The formula itself, the benefits, the limitations, the specific applications,
Right.
even how it can promote financial literacy.
It's a powerful concept with a lot to offer.
It is. But before we wrap up, I want to touch on one more point that you mentioned earlier,
Yeah.
the importance of critical thinking.
Yeah, critical thinking is key.
We've talked about how the Rule of 72 is an estimation, not a guarantee. So what final thoughts or advice would you offer our listeners to help them approach this concept with,
With a critical but still optimistic mindset.
exactly.
Yeah.
How can they use this tool effectively without,
Without getting carried away.
without getting carried away? Yeah.
Yeah, it's about finding that balance, you know, between using the rule as a guide, but also being realistic about the fact that things don't always go exactly according to plan.
Right. It's not a magic formula.
Not at all.
So how can our listener kind of walk that line?
I think the key is to remember that the rule of 72 is based on an average return.
Okay.
But in reality, your investments might do better some years and not so well in others.
So those returns are going to fluctuate.
They are. It's like a roller coaster sometimes.
Exactly. So we can't freak out every time there's a dip in the market.
You got to stay focused on that long-term picture.
Right. Ride out those waves.
And don't be afraid to adjust your strategy along the way as needed.
Okay, so be flexible, be adaptable.
Exactly.
And I think you touched on this earlier, but diversification is also key, right?
Oh, absolutely. Don't put all your eggs in one basket.
Never a good idea.
Spreading your money across different types of investments can help you manage that risk.
Right, because if one investment isn't doing so well,
The others might be picking up the slack.
exactly. So you're kind of smoothing out those returns over time.
Exactly. It's all about balance and spreading that risk around.
Okay, so diversification, flexibility, those are all good things to keep in mind. Anything else our listeners should be thinking about when applying the Rule of 72?
Well, remember those fees we talked about earlier?
Oh, yes. The silent killers.
Be diligent about comparing different investment options and look for those low fees.
Because even a small difference can really add up over time.
Oh, yeah. It can make a big difference to your overall returns in the long run.
So it's worth doing your homework and finding those low-cost options.
Definitely. Every little bit counts when it comes to investing.
I love that. It's all about being a savvy investor and really understanding where your money is going and how it's working for you.
Absolutely. It's your money. You deserve to know how it's growing.
Okay, so we've covered a lot of ground today. I think our listeners have a really good understanding of the Rule of 72 now.
I hope so. It's a fantastic tool to have in your financial toolbox.
It is. But before we go, I want to leave our listeners with a bit of a challenge.
Okay, a challenge. I like it.
Now that you've learned about this powerful concept, I want you to put it into practice.
Yes, put it to work.
Think about your financial goals, whether it's saving for down payment, planning for retirement, or just growing your wealth.
Yeah, any financial goal.
Use the Rule of 72 to estimate how long it might take you to reach those goals.
It's a fun exercise.
Play around with different interest rates.
See how those small changes can affect your long-term outlook.
And most importantly, remember that time is your greatest ally when it comes to investing.
It really is.
So the sooner you start, the more time your money has to compound and grow.
So don't wait. Start today.
Exactly. Embrace the power of the Rule of 72 and start building your financial future today.
Imagine the possibilities.
Thanks for joining us on this deep dive into the Rule of 72.
It's been a pleasure.
Until next time, happy investing, everyone.